What's up, everybody? So in this section, we're going to talk about zones and ranges, right? Now, a lot of people, they confuse the difference between zones, what are ranges, how big should a range be for you to take a trade? If we're within the range, what should we do at that point? If price is at a probable zone, what's going to happen? Will that zone break or will that zone be respected? Stuff like that, right? And it's very, very important because once you see these situations happen in the charts, you start to second guess yourself. You start to think that, okay, maybe this is going to work, or if it's not going to work, or like, price has left a zone or price has left a support or resistance. Should I take a buy over here, or should I take a sell over here, or should I wait for a retest, right? So the biggest question is, if we're in a zone and you have a range in front of you, or like, if you have a clean range to the left hand side, the biggest question is that, should I wait for a retest? Or should I just do an impulse entry for price to go wherever I think price is going to go, right? And a lot of people get confused in those different scenarios, right? So we're going to talk about that. And we're also going to talk about when zones are basically broken, like what times you have when zones are broken, when are they respected. So let's get to it. So first things first, let's say we have a resistance, right? And this is your regular resistance right here. Now, when you have a resistance, you have to understand that a resistance is not a specific price, right? Because when I first started in the beginning, I would look at that and I would say, okay, you know what? It's a specific price. Let's say if we're looking at pound yen, I would say, okay, you know what? This is basically, let me just do this right here. I would say, okay, my resistance is at 160, 500. Right? Ideally, it's not at 160,500 because this area you see, these are collection of prices, right? This could be between 160, let's say 160,450 to 500. It's not always 160,500. So whenever you're taking a look at charts, whenever you're trying to see where your resistance is, it's not a specific price. It's the range of prices. So that's what your resistance is right there. It's a range of prices, right? So that's your resistance. Now at the same time, let's say we have a support area down over here at this point, right? So you have your resistance, you have your support. Now, a zone, right? So this is your zones. A range is the distance between two zones. That's your range. So the distance between these two zones, let's say this is a distance of 30 pips. This is your range right over here. A range is going to tell you that whether or not you're going to have a higher probability to win a trade or not. That's what the range is going to tell you. Now, for me, if I like to take a trade, I like to have a range of about 30 pips, right? This could be, let's say, for example, if price made a high right over here, price came down, created support, and now you could say that, okay, like, you know what, maybe this range is 10 pips. If you have a 10 pip range and you want price to retest the high at this point, this is a very, very small range. It's not going to work out for you, right? So we're going to imagine that this 30 pip range doesn't exist, and we're going to say that, okay, like, maybe if this is a 40 pip range, if this is a 40 pip range, this is going to be a much better idea for you to execute on a trade. Now, let's start from the very, very basics, right? So you have two zones and you have a range in the middle, okay? And for better explanation, let's say this is a 40 pip range. Ideal range. For me, an ideal range is between 30 and 40 pips. Sometimes, like I can execute on a 20 pip range or a 25 pip range, but it all comes down to experience. It all comes down to how many times have you seen certain things play out in the market, right? So in this case, we're only going to take a look at a 40 pip range. Let's say your range is 40 pips. Now, for example, let's say you have a candle and this candle is closing bullish here in this range. Now, if a candle is closing bullish in this range and you got a 40 pip range, and if you're saying that, okay, the next candle has a higher probability to continue up towards our resistance zone, the best opportunity is going to be to anticipate the next candle to wick down without breaking this low and to continue pushing up. Even though this is a 40 pip range, understand this one thing. Now, I hope people are making notes. Understand this one thing. If you have a 40 pip range, it's not always that price will reach to the opposite end. It's not going to happen all the time. Right? Which is why whenever you take a trade in a 40 pip range or a 30 pip range, you are securing what you can secure, like, 15 pips, 20 pips, 25 pips. You can easily secure in this 40 pip range, no problem. But also note that the candle is near this zone. The closer the candle is to a zone, the better the probability that you can have a winning trade, right? What I mean by that is, like, if a candle leaves the zone, let's say you have a candle at this point and the candle leaves the zone, the further away a candle moves from a zone, the higher the probability that it may come down to do a retest. Now, there's one thing that I've seen traders do all the time, whether you're coming from YouTube or you're already in market fluidity. I've seen this thing, where people do this all the time. You're going to have a candle closing away from a zone. Let's say that this zone here doesn't exist. Let's say we have clean candles to the left-hand side, and we've moved further away from the zone in a manner that a candle closed like this, right? Well, now what guys are going to say is that, okay, since we have volume at this time, we're going to anticipate the next candle to wick down, break this high, and then continue to push up. Now, on paper and theory, this looks good. Right? This looks good, but the probability of price moving further up, it becomes lower than the probability of price retracing to create support, unless you have a lot of volume, right? Unless you're running at pre-London, you're running at London Open, unless you got a lot of volume, it's going to be a very low chance that price will continue to push up. Most probably what's going to happen is that price may move up, and then it may continue on pushing down. This has happened to a lot of people in the past as well. Like, price may do something like this, like moves up, breaks the high, comes back down, and closes a bearish candle like this. And now you're, left holding the ball on the losing side, right? So whenever you have a candle that's breaking outside of a zone, and it's like, I would say maybe if it's like 15, 20 pips away from a zone, there's a high probability it's going to do a retest. I'm not going to execute on that candle. I may execute when price comes down to do a retest. So ideally, what I would want to see is that whenever you have a candle that's breaking above a zone, it needs to be closer to the zone, right here, okay? Because, listen, the closer the candle is to the zone, the higher the probability it's going to leave that zone, especially if that's a 30-minute time frame. 15-minute depends on the situation, depends on the amount of volume. 1 hour time frame, 30-minute time frame, they're awesome. If you have a candle that's closing at a zone, like a 30-minute zone or a 1 hour zone, it has a higher probability to leave that zone, or it has a higher probability to reject that zone. For example, let's say like we move back to our resistance at this point, right? And this is your 40 pip range. And if price comes up, your price is at at a resistance at this point, and we're basically creating a resistance right over here. If we're creating a resistance right over here, and this is a 1 hour zone or a 30-minute zone, then there's a high probability it may continue to push down. There's a high probability. Now, I'm not going to say that this is valid in a range. Even if you have a range, you have to take this trade when there's volume in the market, like pre-London, London Open. And this range also has to be like a 40 pip range, like a 35 to 40 pip range. Sometimes we can have a 30 to 40 pip range, but price is just not really moving. Candles are not that big enough. Sometimes you can have, a 25 pip range. If you have a 25 pip range, and you're taking a sell right here, what are you trying to get? If this is a 25 pip range, let's say an average spread is like 1.5 pips to 2 pips. Now you're left with a 23 pip range. 23 pip range. What are you trying to get? 10 pips out of it? No, man. Nothing. It's not going to work like that. Now, another thing that I see people do all the time is that, okay, so let's remove this area here, right? Let's remove this, and let's remove this, and let's do something like this. You got a support area, you got a bearish candle closing right here, you got a, okay. The reason why don't take a sell within the range when the candle is in the middle of a range is because when a candle is in the middle of a range, there's a 50-50 chance. There's a 50-50 chance whether the candle is going to go up or it's going to go down. There's a 50-50 chance because now we're in the middle of a range. And even if this is, let's say it's a 45 pip range, right? If we're in the middle of a range, even though you can say, okay, you know what, hey man, we got a 20 pip range to move to the downside, 20, it's still in the middle of a range. You have to look at probabilities, right? Probabilities. Probability dictates that there's a 50-50 chance that the next candle may move up or it may move down. There's a 50-50 chance. So we only have to execute when the probability is in our favor, right? Let's say we are right over here. We are right over here. Right? It's closer to a zone right here. The closer price is to a zone or the closer candle is to a zone, there's a higher probability for price to reject that zone or for price to leave that zone, right? So now, whenever we're going to talk about sells after resistances, we're talking about sells after resistances in downtrends. Whenever we're going to talk about buys at supports, we're only going to talk about buys at supports in uptrends. Perfect. Hopefully we're all making notes, right? So, this is the basics. You got your zones and you got your ranges. Whenever you're trying to take a trade, you have to make sure you have a big range, like a 30 pip range, 40 pip range. You know, on gold, you can easily get a 40 pip range. These days, there's a lot of volume in pound yen. You can get an easy 40 pip range, 30 pip range. As you go down ranges, like let's say as you go down towards, you know, like a 25 pip range, for you to get that trade or for you to get that move gets a little bit harder, you know, because then you're anticipating the candle to move like 10 pips, 15 pips, you know, 20 pips if you're lucky. So that's what happens right there. So whenever you're taking a look at your ranges, first things first, you need to see how much of a range do you have. If you have a 40 pip range or a 30 pip range, you're like, okay, perfect, you know, I got a 30 pip range and I can execute a trade in that range. Okay, awesome. Second is, where is the candle closing? Where are you taking an entry? Are you taking an entry near a zone? Right? Are you taking an entry near a zone? Or are you taking the entry once price has left the zone? If you're taking an entry when price has left the zone, the chances of you winning the trade is 50-50. And we're not in this business to make money on a 50-50 chance. We're in this business to make money where the probabilities is in our favor, right? So always you have to make sure that you're trying to execute when price is near a zone. Near a zone, because then when there's volume can push price down, or from here volume can push price up if we're near a zone at this point. Right, now zones and ranges, they may seem simple, but when price is moving, you know, FOMO gets in the way, over trading gets in the way, revenge trading gets in the way. We really need to understand, we really need to control that. You know, those feelings are really going to fuck you over in the markets. Okay, so you have to understand, whenever you're taking a look at the charts, you have to measure how much range do you have. Is it even a tradable range, right? If you're looking at a tradable range, do you even have clean traffic to the left-hand side? It's very important to have clean area to the left-hand side where price has moved easily to the left-hand side in the past, and now you can expect price to move there easily as well. So again, I'm going to reiterate everything, right? First things first, you need to know where your zones are. Once you have your zones, you need to understand how much range do you have between those zones. If price is going to break resistance, do you even have enough range for price to move in? Because if you have enough range for price to move in, that means you can grab a part of that move. Not the whole move, the part of that move. If you want to grab the whole move, then you're maybe, you know, you're letting a runner run. You're letting like, you know, 10% run, 20% run, 15% run, whatever that number is. You're letting those runners run, but initially you're securing what you can secure in that range. Right now, study this, make it a habit. Whenever you're trying to analyze charts, make it a habit to plot out your zones and then measure the range. Is there enough range? And for the first few months, just sit and watch. Sit and watch to see how price moves between those zones. Thank you.